The U.S. Federal Reserve cut interest rates last week for the first time in 4.5 years, lowering the benchmark rates that have been kept at a bruising 20-year high in America's battle against inflation. Now, what's behind this long-awaited policy pivot? And, of course, what does it mean for South Korea? When should be okay also follows suit. What about its impact on the upcoming U.S. presidential election? For some clues, we now connect with our weekly commentator, Professor Jun-seok, economics professor at the Catholic University of Korea. Good morning, and thank you for joining us, Professor Young.
Good morning.
Maybe you can start out today's conversation by explaining the timing and the scale of the rate cut. Why did the U.S. Fed's rate cut come now, and why did the central bank opt for a big cut of 50 basis points?
Okay, well, the rate cut was widely signaled, and it was so expected. The first reason is that inflation is, likely under control. Now, inflation rate right now is not completely back to the Fed's goal of 2% per year, but it's getting there. The consumer price index inflation, the latest number for which was for August, is 2.5% for headline inflation, 3.2% for core inflation. So that's still high, but it's been coming down steadily from the high of 9.1%, but a year and a half ago. And the Fed's preferred measure of inflation, the personal consumption expenditure, or PCE inflation, the latest number there was in July, but those numbers are 2.5 for headline and 2.6% for core. So inflation has become less and less of a problem. But this is a second point. The employment has been worsening in the last few months. The latest monthly job creation figure for which was for August, is 142,000. That's higher than the July numbers, which was only 89,000, but it was less than expected. The unemployment rate is 4.2%. That's up from 3.7% in the end of December last year. The rate of increase for the unemployment rate is fast, but it's mostly due to rise in labor supply rather than any large job cuts. So it is not a bad number. And before pandemic, the full employment was somewhere between 4.5% and 5%. So you can still argue that U.S. is still low for the full unemployment numbers, so U.S. labor market is very good, but the rate of change has been just too quick. So the Fed, as well as other analysts, have been worried about the labor market. So the big question was not that the Fed would reduce, whether they would reduce the rate or not, but by how much. The Wall Street traders and analysts expected 50 basis points. Academic economists expected 25 basis points, and it turned out to be 50 basis points. While the numbers itself may not be that bad, I think the pace of the change was what really alarmed the Fed members. The Fed and the Chairman Powell, when they cut rates by 50 basis points, they've stated the following reasons. First, unlike most central banks, which target price stability only, the Fed has a dual mandate: price stability and maximum sustainable employment. And Fed wanted to signal strongly that their stance has changed. Emphasis had been on maintaining inflation, but now they want to signal very clearly that the focus from now on is going to be maintaining maximum employment rather than inflation. And somewhat related to that is the second point. The Fed wanted to give the new policy stance a strong push. So rather than a baby step of 25 basis points, they decided on 50. And then the third, Fed views current rates as restrictive. The interest rates are too high, so it wants to get back to what the economists call neutral rate of interest, or a neutral stance, very quickly. Neutral rate of interest is interest rate which does not help or restrict the economy. No one's quite sure where the neutral rate is right now, maybe 2.5%, but they want to get back to the neutral stance as quickly as possible. And then the last point was that they had labor market statistics revision since the last FOMC meeting. And all of the labor market numbers, job creation over the last 6 months or so was lower during the revision. So all the numbers have been lower than expected. And Chairman Powell during the press conference said that if the Fed had known about these revision numbers before July meeting, the Fed may have lowered the rate in July rather than September. So for these reasons, the Fed decided on a big cut rather than the baby step of 25 basis points.
The U.S. Fed also has two remaining monetary policy meetings this year in the months of November and then in December. What is your projection for the likely path of interest rates?
Okay, well, this time the FOMC published their so-called dot chart, where each FOMC member tries to estimate where the rates will be at the end of the year. And for the end of the year for 2024, the opinions centered around 4.5%. And with the rate cut, the current rate is 5.0%. So 2 additional cuts are expected. There is some dispersion of opinion, and the Fed continually says that it depends on the data. So the possibility of change exists, but right now the best bet is that we will have 2 baby steps, one in November and one in December. Now, during the Fed meeting, the U.S. stock market hit a record high during the meeting, but went into negative at the end of the day. The widely reported reason was that the market wanted more and faster cuts. In early September, the market expectation, despite what the Fed was saying, was that the Fed would cut by 1.25% by the end of the year, 2 big steps with a baby step. And some progressive U.S. politicians like Elizabeth Warren wanted even more, 3 big steps, total of 1.5 percentage point cut by the end of the year. But I don't think that's going to happen. The Fed is going to be more careful than that. What's more interesting is what's going to happen next year and the year after. The dot chart shows that on the average, the FOMC expects another 1% point cut by the end of the year, ending at 3.5%. So if the dot chart is correct, then we will have 1 percentage point cut this year and 1 percentage point cut next year. But the further in the future you go, wider the differences of opinion, wider the dispersion. Perhaps the big change in this dot chart is that after 2025, rate cuts slow down substantially. The interesting point is the long run, what the Fed expects in 2028 and beyond. And the long run rate actually went up. It was about 2.5% 6 months ago. But now, even though there's a wide dispersion, the average is 2.9% or very close to 3%. And that's going to be problematic for Korea. The long run rate may affect how much and how quickly Korea can cut its own rates. But we should note that during the press conference, Chairman Jay Powell emphasized that the interest rates will not return to what we saw during the pandemic. Now, the many academic economists are now arguing that during the high inflation in the last 18 months or 2 years, there was what's called a structural break. The neutral rate of interest, which I talked about, may have gone up, and that's because people's expectations of future inflation rate has gone up. So we will not be returning to those interest rates in the 0% range that we saw during the pandemic, and that's probably going to be true for Korea as well. People seem to forget that the rates during the pandemic was an emergency rate response to slowdown in global economy, slowdown due to the pandemic and the aftermath of the 2008 global financial crisis. So it's unlikely that interest rate will go back to where it started from. And the interest rate where we started from was never normal. It was an emergency rate during the pandemic. So if you're expecting the rates to go back to that level, I think you better reformulate your plans.
All right. Of course, there are questions about the rate cuts effects on the November election because it did come just about 7 weeks until the U.S. presidential election. Questions have been raised whether the rate cut is even advantageous to either of the presidential candidates. The U.S. Central Bank is an independent body, but how do you assess the potential political impact of the rate cut?
Okay, well, usually the Fed refrains from changing rates near election time, say the latter half of the election year. But this year has been unusual in many ways. Now, candidate Trump has stated that his economic policy will be based on low interest rates and tariffs, which would lower inflation and raise growth. But if you look at these two main points, they tend to raise the tariffs tend to raise inflation. Higher growth also tends to raise inflation. So I'm not sure if candidate Trump realizes how contradictory his plans are. But his desire to have low interest rate implies that he will try to control the Fed. And the president does have ways to pressure the Fed, most notably by naming the Federal Reserve governors and chairmen. And it had happened before where the president pressured the Fed to lower interest rates near election times during the early 80s, during the early 70s. Then President Richard Nixon pressured the Fed toward loose monetary policy to make his reelection easier. And the candidate Trump, it's widely perceived that when he was president, Trump pressured the Fed into making at least one rate cut. But the candidate Trump also stated that despite his statement that he will lower the interest rate once he is president, he also tried to pressure the Fed into not lowering the rates before the election. So the Fed may have lowered the rate in small part to rebuke Trump's pressure to assert independence from candidate Trump to get around this perception that during his last term, he pressured the Fed into lowering the interest rate at least once. Now, politically, the rate cuts are thought to favor the incumbent, which in this election means Kamala Harris. But there's really very few examples of rate cuts near election times helping candidates one way or the other since Fed refrained from changing rates near election dates. But because monetary policy cuts in interest rates are thought to have a time lag of 3 to 6 months or perhaps even a year before showing up in the economy, and the election is November 3rd, so it's less than 2 months away, it will likely be not felt, the effect of the rate cut before the election times. And even during the years when there have been a general trend of lower interest rates, it did not necessarily help the incumbents. But if the rate cuts leads to a higher stock market and a generally optimistic economic environment, economic feelings by the electorate, then that will help Kamala Harris, the incumbent.
Which brings us to our final question. What does a rate cut mean for South Korea? Markets are hoping for the BOK to follow suit with a rate cut at next month's policy meeting. What are your projections, Professor Yang?
Okay, well, if the Fed had cut the rates by only 25 basis points, I think there was a good chance that BOK would not lower the rates for Korea. Note that the BOK doesn't really have that many policy tools. It controls the interest rate, and it has a few regulatory tools for stability of financial institutions. But most specifically, BOK does not have regulatory tools to control where the money goes after cutting the interest rates. The regulations which can direct where the money goes belong to the executive branch, the government, the Financial Supervisory Commission, the Financial Supervisory Service, and various ministries. Now, since the government suddenly and unexpectedly delayed the implementation of these strengthened DSR standards, household debt and sole housing prices have exploded. And in order for lower interest rates to help the moribund domestic economy, money freed up by lower interest rates must flow into spending, consumption, and investment. But if when the BOK lowers the interest rate, if all the money that's freed up from by the lower interest rates flow into household debt and sole housing market, it actually will make situation worse by worsening the economy and financial stability by increasing the already high household debt levels. And the money flowing into the housing market may start creating a housing price bubble. So if that happens, then it's actually better not having a rate cut. And the Bank of Korea was signaling such possibility. So if household debt and housing prices kept rising, then BOK said that it may delay cutting interest rates. In my opinion, that's basically BOK signaling to the government that they need to put in some new regulations on debt and housing prices if the BOK was to make a rate cut. And while generally the government has gotten the hint, it also flip-flopped by giving inconsistent signals, instituting inconsistent policies and measures. And these measures seem to be not fully thought out, and government had to take back some of them. So before the Fed made the big cut, there was a big possibility that BOK would not lower the rates at all. But because the Fed cut the rate by 50 basis points rather than 25, it does give, at least in the short term, BOK more room to maneuver. And it also gives the critics more room to demand a rate cut, saying that the situation is worse than believed because the Fed made such a big cut. So BOK should split the difference. U.S. cut the rate by 50 basis points, but Korea should cut the rate by 25 basis points. But it still leaves the household debt and housing price problems, and that's going to depend a lot on what government does until the BOK meeting in October. Now, I mentioned the long-term U.S. rates earlier. Right now, the long-term interest rate for U.S. seems to be centered around 3.0%. And Korea right now, the policy rate is 3.5%. And the U.S. interest rate is higher than Korea, the so-called interest rate reversal. And that means unless Korea really wants to keep the Korean rate below the U.S. rate for additional years, which can be very dangerous if the global economy returns to normal, because it may lead to rapid capital outflow to Korea to more profitable countries. Unless we want to take that risk, Korea will have to raise its interest rates above the U.S. And so Korea really doesn't have that much room to maneuver. Right now, Korea's policy rate is 3.5%, and U.S. long-term rate after 2028 is going to be 3%. U.S. has about 2.5% point room to maneuver to bring the rates down, but Korea only has perhaps about 0.5% point to 1 percentage point. So it may really pay for Korea to lower the rates slower than the U.S. Otherwise, Korea may have to raise the rates sometime in the future before 2028 to make the Korean rates above U.S. rates.
Thank you so much, Professor Yang, for today's insights. We'll speak to you again next week.
Thank you.
We spoke to Professor Jun-seok this morning, economics professor at the Catholic University of Korea. If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.